Welcome back to Focus on the Future. You know, one of the toughest checks that I ever write every month is my premium for my insurance, whether it be homeowners or auto or life insurance. It just bugs me a little bit because I cannot see that I'm spending this money and getting any value back. Lo and behold, however, when something happens, all of us wonder, are we covered enough? Do we have enough insurance? So today we're going to talk about the insurance experience a little bit and the insurance relationship. And we're lucky to have with us Kathleen Benavides, who is an Allstate agent in the City of Vision, Rio Rancho. And we are in her office today. Good morning, Kathleen. Great to see you.
Good morning, Skip. Thanks so much for coming by.
You know, every year we talk about auto insurance and health insurance, renter's insurance, and we really never relate it to individuals and in terms of how insurance impacts lives and how perhaps things can change in an instant. And I understand that something has happened to one of your clients recently, a little story that perhaps you can share with us.
That's right, Skip. My good friend Laura. She's got a 17-year-old daughter. Her name is Julie. Great kid. She's a fabulous student, but she got in a really bad accident a couple of months ago, and you wouldn't believe how this one little incident has turned their lives completely upside down.
Well, tell us about it. What actually happened?
Well, Julie was driving her new Jeep, the one that she got as a gift for being such a good student.
You know, I remember you telling me about that.
Yeah. I mean, my friend Laura wanted to reward her, so she got her a new Jeep. Anyhow, she was texting her friends. She wasn't paying that much attention, and she didn't see that the car in front of her had stopped at the intersection.
She was texting while driving?
She was texting while driving,
Wow.
And the light was green, so she didn't think anything of it. She took her eyes off the road for just a split second, and you know what? She plowed right into the back of that SUV. It stopped because a bicyclist rode out in front of her.
Oh my gosh.
Unfortunately, she pushed the SUV into the bicyclist and killed the bicyclist. It's really terrible.
Oh my gosh. That's awful.
It is.
Well, now they were fully covered because, I mean, you and Laura have been friends for a long time and she knows you're in the business, so surely the insurance took care of all of it, right?
Well, sure, she has insurance, but it's not quite that simple, Skip. I mean, my friend Laura, just like you know, hates writing that check and was trying to save a little bit of money, so she really only bought the state minimum coverage. She did have comprehensive and collision coverage on the vehicle, but the biggest part of this claim is going to be paying for the death of that poor bicyclist.
Oh my gosh, I can understand that. You know, let's go back and examine what you said. You said she had minimum state liability coverage. What does that mean?
Well, every state has different requirements as far as what you're required to purchase for liability. So, for example, in our state, the minimum is only $25,000 per person,
right.
$50,000 per accident.
Right.
So if you go back and you think about it, $25,000 to pay for the death of somebody, that's
not going to even come close to covering that.
It's not enough money, not at all.
No way. Now you also said she had comprehensive and collision. Is that what everybody calls full coverage?
Right, that's what people commonly refer to as full coverage.
Okay.
And you know what I always say, Skip?
You call it something else.
I say if you think you have full coverage, you really have FOOL coverage, because there really is no such thing.
So you're fooling yourself into thinking that you're totally covered. And in this case, your friend Laura and her daughter, Julie, was just not at all.
That's right. They're not fully insured for what they need to be to cover all the elements of this loss.
Right.
And so a lot of people mistakenly think, well, I have full coverage. Everything is going to get paid for. Well, guess what? It doesn't. I mean, this was a new Jeep that my friend's daughter was driving. She'd only been paying on it for a few months. Well,
right.
Guess what? She hit that SUV so hard, she totaled out that Jeep, and it's not worth what the loan value is.
Well, I can imagine the airbags came out on the Jeep like they had to with that kind of impact.
Oh, yeah.
They totaled the Jeep.
Absolutely. The airbags deployed, the front end is completely smashed in, and my friend's going to have to pay about $3,500 out of her pocket.
So she didn't have gap insurance on this vehicle?
No, she didn't have gap insurance, and she's what we call upside down on the loan. Meaning,
what does that mean?
Well, it means you owe more on the vehicle than the vehicle is actually worth. So when a car is totaled out, the insurance company doesn't pay off the loan, they pay what the vehicle is worth at that time. And as you know, the minute you drive that vehicle off the lot, it depreciates in value like a rock.
Well, yeah, I've heard like 25% as a matter of fact. Now, had she had, well, I guess we should define what gap insurance is for our viewers, because perhaps a lot of folks don't know.
Well, gap insurance is something that you can purchase on a new car so that it will cover that gap when you owe more than the vehicle is worth. And so you can buy that, and we actually do have some products available to add that onto your policy.
So, and it's pretty common, I would think, when somebody finances a vehicle, when they walk out of the dealership, that there is a gap between what they owe on the vehicle and what it's actually worth book value.
Right. The thing to watch out for is that gap insurance is usually only available for newer model vehicles, and that's usually vehicles that are within the first three model years.
You know, we should also point out that you can buy the gap insurance at your dealer.
You can.
But that's probably not a good buy, is it?
No, it's better to look around. I mean, ask your local insurance agent if they have any products available to cover that gap for you, because you can buy it at the dealer, but it's going to cost you a whole lot more than if you add it onto your auto policy.
Well, what about folks that don't have an insurance agent? I mean, there's lots of folks that just buy their insurance online and don't worry about it, right?
Well, and that's why we talk about the value of having an agent, because who are you going to ask when you go online or when you call 1-800 somebody?
Yeah, but still, your friend Laura had an agent and she elected not to buy the correct liability coverage.
That is true.
I assume you had advised her to do that.
I did. We had a long conversation about it, and it came down to she's a single mom, you know, trying to cover all of her expenses, and when you have a young driver, that tends to make the insurance go up, and she's trying to do everything she can to balance out all her expenses and pay all her bills.
Oh, believe me, I can understand that. It's like I said in my opening, I hate writing the check, but my gosh, I would also hate facing a bill of the proportion that perhaps Laura and Julie are looking at. What happened next on this deal?
Well, the story gets a little worse here. I mean, now we're looking at the death of this bicyclist, but the SUV that Julie hit had a lady and 2 kids in it. They're claiming injuries as well.
Oh, for crying out loud.
Now there's lawyers involved. Now you have 3 people that are trying to make injury claims against this policy. And remember, the limits were $25,000 per person, $50,000 per accident. So now you have $50,000 total, and you have 4 people that are making claims. One of them is a fatality, and the other 2 are going to the chiropractor and seeking medical treatment.
Okay, well, let me understand this exactly, that 25, 50 that you're talking about, because those that's the minimum liability situation, correct?
That is correct.
Okay, so you've got how many people involved? 4 people involved.
4 people now.
Is it $25,000 per person?
It's $25,000 per person, but the total can't be more than $50,000.
Oh, that's what the 50 means.
That's what the 50 means.
Okay, well, what kind of liability insurance should they have had on this vehicle?
I would recommend at least $100,000 of liability coverage.
Really? And that would be $100,000 per person?
Right, and then you get a $300,000 per occurrence.
I gotcha, and probably even that wouldn't have covered this completely.
No, but it would still be enough to try to get them settled out of the claim. I mean, when you really only have $25,000, nobody gets enough to cover expenses to cover anything.
Right.
When you have higher limits of liability, there is more money to cover expenses. Things like emergency room, ambulance bills, medical treatment, lost wages.
How much more expensive, Kathleen, would it have been for Laura to buy that coverage versus what she did buy on the liability side?
Maybe about $60.
$60 a year?
No. Every 6 months.
So $120 a year. Boy, it's a small price to pay once you figure out what the cost of this is going to be, isn't it?
It is, and unfortunately, people just look at how much do I have to write that check for every month.
Wow, I bet she wishes like crazy right now she'd spent that extra $120.
Well, she does now.
She does. Were there any other implications beyond this? I mean, what a tragedy. I'm so sorry.
Yeah, this whole thing is just turning out to be really ugly. The other thing is that the police are investigating Julie. They're deciding if they want to charge her with a crime because she was texting while she was driving. And they're trying to say that she actually was guilty of vehicular homicide. So
what?
Exactly. Yeah, they're trying to say that she, because she was texting, they're trying to equate it to like drinking while driving because she was texting and not paying attention to the road.
So they're trying to prove negligence in this situation.
Well, not only negligence, because the family of the man who was killed, I mean, they've filed a lawsuit, so they are looking for something from my poor friend, but the police are looking at whether or not they're going to do criminal charges. And if criminal charges are filed, Julie could lose out on a lot. I mean, she's a top student, but that might implicate her chances of getting a college scholarship.
Well, yeah, I would certainly think so. With a felony conviction, what do you? And that is a felony
conviction.
Right.
If she gets a felony conviction, that's going to ruin her chances of getting into a good school.
Wow, Kathleen, you know, you think about how many of our listeners have texted while driving. And I've done it. I got to admit, I have done it.
Skip, I've done it too. And you know, when I did it, I told myself, God, this is so wrong. And I did it anyways.
Yeah, well, you don't stop to think about what could happen. And you said this happened within a matter of just a split second.
Just a split second. I mean, the bicyclist started out, the SUV stopped, and Julie didn't look, and she hit it, and everything turned upside down in just a second.
Well, now, how much is Julie's insurance coverage or Laura's insurance? I guess both of them. How much is going to be paid here, and what's the position of the insurance company? Will they help them? Will they step in, help with lawyers and all that stuff that's going to happen?
Absolutely. The insurance company will step in, and the insurance company will pay for the defense lawyers to get this claim settled out. And ultimately, it's the insurance company's goal to settle the claim and get a release for the insureds, which means they can't be sued anymore. So, I mean, that's what the insurance company will try to do. But if they can't, I mean, there's no obligation of the other party to settle the claim. If they can't and it goes to court, my friend Laura stands to lose quite a bit.
Because now she's going to have to hire an outside attorney to defend her daughter as well in this possible criminal action, correct?
That is correct.
My gosh. Well, let's talk just a little bit more about the poor guy on the bicycle. I assume it was a male on the bicycle?
Yeah, it was a gentleman on a bicycle. He was married. He had a wife and a young baby. And so, you know, they're looking to find some recovery. If there's any good news here, I did read in the newspaper that he had life insurance. So at least his wife and child won't lose their house.
What do you mean they would lose their house? What do you mean?
Well, he was the primary breadwinner. His wife didn't work. She was a stay-at-home mom. And so they need income to pay the mortgage. And so he did have life insurance. And that's, you know, like I said, if there's any good out of this, his life insurance policy will pay his wife and she won't lose the house. You
know, we talk a lot, you and I, about life insurance. And you know my philosophy about it. I'm a guy that believes primarily in term insurance and covering needs. And I can understand when you have children and a spouse that's not working and you have ongoing expenses, you absolutely have to have life insurance. But there's a difference between term insurance and what we call universal or whole life.
Right.
What's the difference between those two policies?
Well, I'm glad you asked. And it's really important when you're talking about life insurance or any insurance for that matter to ask questions. And that's the thing I always tell you the most is what's the most important thing? Ask. You need to have an agent that you can talk to and that you can ask questions of. And so term insurance, actually it's called term because it has a term of expiry or otherwise it ends. It comes to an end. You buy it for 10 years, 15 years, 20 years, and then it's over.
Right.
Okay?
Right.
Universal life or whole life as they call it is designed to cover you for your whole life. And so usually those policies go up to age 95.
Okay.
Now the difference is, okay, it's like, well, why would I buy a policy that ends? Well, it's cheaper.
Yes.
I mean, it's much cheaper to buy a term policy, and some people think, well, this is what I can afford, at least I have something in place. The thing you have to be cautious about, though, is life insurance is cheaper when you're younger. So some people might only be able to afford a term policy maybe when in their 20s or when they're in their 30s. But when you're in your 50s and 60s, life insurance gets incredibly expensive.
Oh, yes, I can imagine. And especially if you have some health issues associated with it. So your advice then to young people would be that perhaps if you look down the road at your financial future and you think that you might need a certain amount of coverage for a long time, life insurance wise, that you could buy it now, lock in that premium for the rest of your life, basically.
You could.
And that kind of policy also builds a cash value, correct?
Right. They do have policies out there that build cash value. Now, you know, in today's economy, building cash value is going to be a slow process.
Yeah, the returns are abysmal.
No, but it still does give you something. I mean, I have clients now who have $20,000, $30,000 of cash value built up into their policies.
Well, one of these days we're going to have a complete knockdown argument, you and I,
between
whole life and term, because as you know, I'm a buy the term and invest the difference kind of person. I just look at it that way. And I understand there's two sides to the argument. And I think that I can see your point of view, especially from the standpoint if there was a possibility that I was going to be uninsurable later on in my life. Because eventually most people are going to get married, have kids, have a family. And when that happens, man, your financial liabilities and the ongoing expenses you're going to have really do go up.
That's right. And you know, I'm not a big proponent of term. I like the universal and the whole life. So I will have that conversation with you, Skip.
I understand that. Let's go back to Julie's story for just a little bit, because I really do feel this is an awful thing for everybody concerned.
Well, if I can just tell you one more thing that happened to poor Julie. You know, she's holding this phone. The airbags went off, threw that phone into her face, and now she looks like she got hit with a baseball bat. So poor thing,
gosh.
On top of having all these legal troubles, car troubles, now her face is swollen up pretty bad.
Will her insurance help with that too, or does that fall back on her health insurance?
Well, thank goodness they do have something called medical payments coverage on the policy, so that does provide coverage for her to go to the emergency room, the ambulance right over there, and a few visits afterwards that she needs for checkup.
What if she has to have some kind of cosmetic surgery to correct any scars or anything from that accident?
The medical payments has a limit. This particular one has a limit of $10,000, so that's all it will cover, but at least it covers something.
Yeah, I mean, it's better than walking into the doctor's office with no coverage at all. Let's come back to this SUV people for just a little bit, because you said they were filing a suit. What's their beef?
Well, they haven't filed suit yet. They're just trying to make a claim for the injuries. So the lady who was driving is saying that, you know, her neck and her back are injured. She can't go to work. And her two kids in the car, she's taken them to the doctor as well, that they're claiming neck and back injuries as well.
Well, now, wouldn't the SUV's insurance, auto insurance, cover that, if assuming they were insured? I don't know that they were.
Well, not necessarily, because when you're looking at auto insurance, if you're going to make a claim for injuries, you want to make a claim for the person who's at fault. And in this case, Julie is at fault.
So what about and this is an awful question I'm going to ask you. But looking at it from a strictly legal and insurance point of view, you started out by saying that the light was green.
Right.
And this bicyclist crossed against the light. Doesn't he have some liability here?
He could have a little bit of liability. In different states where you have comparative negligence, the law says that the fault is going to be apportioned to each person according to what they did or didn't do. But here's the kicker. That SUV was able to stop and avoid him. She didn't hit him. Julie comes along, plows into the back, and pushes everybody forward.
What a nightmare.
And since the guy was killed, it's really kind of difficult to say, well, the dead guy's at fault. I mean, it's just one of those things that's really tough to get into.
Like I said, I hated asking the question.
Yeah, it's a really hard situation, because nobody wants to go and tell this man's poor widow, guess what, your husband, you know.
Oh my gosh, I just can't imagine. I mean, and this all changed in a flash. It was,
in a flash.
Life was terrific, everybody's great, and now Julie's facing this situation that, oh my gosh, wow. You got to have a lot of courage to get through this.
Oh yeah.
No doubt. But I think you certainly prove something here. And if there's any good in this at all, it is that somebody that's heard this story will look at this and say, oh my gosh, I really need to look at my liability coverages and what I'm covering on my insurance. But, you know, more importantly than that, maybe they will give a second thought to that texting on the way home from school today.
Absolutely.
Maybe so.
I hope so. I mean, and again, there's the value of having an agent, having somebody that you can ask questions, and saving money isn't always the #1 purpose with insurance, because insurance protects you down the road when you really need it.
Boy, I couldn't agree with you more. Thank you so much. It's great to be here in the City of Vision, Rio Rancho, with you here at your Allstate office. And for those of you watching in New Mexico, come see Kathleen. She'll help you.
Thank you, Skip. I'm so glad you came by today.
Thank you. Well, Emily, that was a tragic story indeed, and I hated hearing it, but in terms of what Kathleen had to impart, there was a lot of information there.
There was a lot of information. There's quite a bit of insurance terminology that I'm still trying to understand. Things like comprehensive, collision, liability, total loss, you know, wrecking a car, things like that. So I think accidents do happen like this, unfortunately. So it makes sense to me to have an agent, have somebody that you can pick up the phone, call, ask these questions, or somebody that you can walk into their office.
Yeah, I think you're right. I mean, it is convenient to buy your insurance online.
Sure.
You never have to talk to anybody. You can do it in your pajamas. You don't have to go to the office. But then when tragedy strikes, who do you call? What do you do? And I think having that insurance relationship, perhaps about all the relationships we talk about, that might be one of the most important.
As you said, it's something that you want to make sure that you have in the event that you need it. You hope that you don't need it. But things happen. You buy a new car, you're going to hope that you have something like gap insurance. So talk to your agent, see if they can give you a good price, or talk to the dealership, or shop that around to see if you can find a good price for something like that.
Well, keep in mind, folks, that buying gap insurance at your dealership, as our buddy Rick Pfefferman says, is probably a chump's move. So I don't know.
So shop it around, see if gap insurance is right for you.
Well, gap insurance is certainly right for you if you've got a gap in your policy. You've got to do that. But it's where you buy it.
It makes sense.
And one last thing.
And finally, liability insurance, liability coverage is fairly inexpensive, as Kathleen mentioned.
Yes.
So it makes sense if you can avoid some sort of disaster or catastrophe like this, make sure that you have appropriate liability limits.
Yeah, I'm sure that Julie's mom is looking at this and say, oh my gosh, I wish I'd have paid that extra $120. I wouldn't have saved the gentleman's life who died tragically in the accident, but it certainly would have saved them a tremendous amount of headache and oh my gosh, it's just awful.
And don't text while driving. If anything, I hope that everybody learned that. That's not a good idea.
I certainly hope so too. What's coming up next, ma'am?
Up next, we have the Budget Buster segment, and then to be followed by the Stock Market Corner. Thanks, guys. Hi, welcome back. This week, we're going to take a look at the balance between needs and wants. Believe it or not, there is a difference, a big one. We certainly don't need everything we want. Heck, just the other day I saw this really cute pair of shoes and I thought, I really need these. But then I gave myself a second thought and realized I already have enough shoes and I can only wear one pair at a time. But seriously, we all have needs. It's pretty true. Most of those are pretty basic. All of us need air to breathe, food to eat, shelter, clothing, water, and a means to secure those basic needs. Other than that, everything else is pretty much a want. It boils down to those two things. You may be able to make a case for the need to have transportation in order to get around, but that one's probably pretty negotiable. Since we're building our budget from the bottom up, the very first thing that we need to cover is the basic living expenses that all of us have. So let's talk about food, my favorite subject right after money. Everyone needs to eat. Most of us eat at least 3 meals a day. How much or how little of our monthly net income we'll spend on food will vary depending on our preferences and our personal circumstances. Naturally, if you have dependents, you'll probably spend a little higher of a percentage on your income with food. If you're single or living on your own, it's probably going to be a little bit less. So here's my first tip. Don't go to the grocery store when you're hungry. You'll find a whole bunch of items that you put into your cart that you probably wouldn't normally purchase. Here's my second tip. Make sure that you use coupons. The Sunday paper usually contains money-saving coupons for items that you buy every single month. Also, the advertisements that come in your mail are free and full of sale items and coupons. You can look for websites for your local grocery chain store. They usually have the coupons on their site. You can look for other websites that offer food coupons. One caution, just because a product offers a coupon doesn't necessarily mean that you need it. And my third tip, plan your meals accordingly. Before you go shopping, make a list of the items that you'll need for the week based on the meals that you plan to prepare. This way you won't have things in your fridge that you never actually use and then they go bad at that expiration date. Oh, remember, eating out is part of your food budget, not part of your entertainment budget. Have fun shopping. Hi, welcome back to the Stock Market Corner. I'm Emily New.
And I'm Tom Crow.
Today we've got some really crazy stuff to be talking about. Tom, the markets are all over the place. We're down almost 500 points today based on some news by the Fed. What's going on?
Yeah, over 500 points in the last 2 days based on the Fed's announcements yesterday.
And that's a big number, right? 500 points is a pretty big deal.
That's several percentage points, and it's probably about the worst week we've had in a couple of years in the market.
Ooh, that's hurting a lot of people then.
Yeah, it's a lot of people are feeling the pain, and a lot of people are panicking. I don't want to say, unfortunately that's what happens, is people start just panic and sell everything, and it just kind of snowball effect drives the whole market lower because people are doing that.
And it's kind of a problem for some of these people that are a little bit older, that are looking to retire, that are counting on funds. I feel like I'm a little bit fortunate as a younger person. Some of our students are a little bit more fortunate. What's happening right now in August and what's going into September is probably not going to affect us as much long term. But for right now, there's a lot of stuff happening. And what did the Fed say exactly that's making this happen?
Well, the Fed said that the economy's not growing as fast as anybody thought it would. In fact, they probably pulled back on some of their expectations. They're expecting slower, more measured growth, if any, over the next couple of quarters. They're expecting unemployment to remain high.
Okay.
They don't see any dearth of jobs being created anytime soon. And they announced a program that they're calling the Twist, which is something they redid, something they did back in the 60s, which is...
Funny name.
It's a funny name, and what they're trying to do is actually twist the yield curve, which is a big technical discussion that we probably don't want to get into. But what it gets into is short-term interest rates and long-term interest rates. And what they're doing is, without any change in the net balance sheet, is they're selling short-term debt or letting it expire because it's 3 months or less. And then when that expires, rather than buying more short-term debt, they're going to go out and buy longer-term debt. And they're going to try and push the yield up on longer-term debt.
Okay.
Actually, sorry. They're going to push the prices up on long-term debt. They're going to push the yield down.
Okay.
And that, in turn, if it bleeds over into the mortgage market and some longer-term, 6, 10, 20-year, 30-year loans kind of thing, they're expecting that to keep interest rates low.
No.
So they're going to keep mortgage rates low and longer-term financing rates low. They think that's going to stimulate the economy. What's happening is that banks have cash, but the feds have come in and put the restrictions on the banks so tight that they're not loaning money anyway.
Okay.
So it's going to keep rates low for a long time. We're going to keep printing money, and we're going to be looking at and low rates and a lot of extra cash means at some point you're going to see some inflation.
Well, and that's kind of what we've all expected, right? That inflation was going to come because the mortgage rates have been so low.
We keep waiting.
But they're going to keep them lower even longer.
And core inflation keeps not changing or just creeping up a little bit. What they're not seeing, because of the way the number's calculated, is you're not seeing the fact that gas is going up, the fact that food is more expensive. And right now, as expectations for demand have come down, we've seen oil prices drop. Now we're waiting for gas prices to follow, which would be nice. We could all use a little bit of a break at the pump.
Yeah, I paid $25 for half of a tank the other day, and I was thinking that's kind of a lot of money.
You don't drive a truck.
No, I don't. But still, $25 is a lot of money. Well, this kind of reminds me of what they did with QE1 and QE2, the quantitative easing. Is this similar to what they did with that?
It's not a direct injection of cash that way, whereas with QE1 and QE2, they actually went and created and bought more bonds, which meant the government created more bonds and the Fed bought them. So the government had more money to spend, and that's what funded the stimulus programs. It still was money that didn't exist,
right?
But
still money that we're kind of loaning ourselves from the future.
We're borrowing from the future, exactly.
Yeah, that kind of scares me. Well, the markets have been kind of all over the place, and I know you have some information about that, and it's kind of crazy. You hear one day we're up, one day we're down. It's kind of a lot all over the place. Now, you look back because that's the only place that we can look. You know, nobody knows the future. But what can you discern from what's happened in this past year? Well,
we have some charts to show you. We'll get those into the show. And what we're looking at is a one-year chart of the S&P 500.
No, S&P 500, that's Standard & Poor's 500.
Standard & Poor's, it's 500 stocks that create an index that S&P has chosen to be representative of kind of the general industrial commercial services market. It's a good cross-section of stocks.
And typically you can't usually beat the S&P 500, right? Because they're picking a little bit from everywhere?
They pick a little bit from everything, and it ends up being kind of a good, mushy average of where the market's going to go.
Okay.
Some people think you can beat it all the time. Usually you can beat it one way and then not the other. If you outperform it up, it means you're taking risk, and you're going to outperform it down as well.
Okay.
If you stay behind it, then the S&P does very well. You don't do as well. When the S&P does poorly, you probably don't do quite as bad.
Okay.
So you can be one side or the other of the S&P, but you probably can't beat it up and down all the time.
I like that somebody kind of figures it out for me. It seems a little bit easier, but that's just me.
Right. Now, if you look at this chart, the section I've circled shows a period starting August of this year, where we really saw some volatility start to spike. You start to see big swings up and down, and a lot more. It looks like violent action in the market.
Yeah, it's real squiggly.
And if you look back earlier in the year, which starting about last September, you can see a nice kind of orderly progression in the market. It was a nice general bull market run.
Now, when you say bull market, I know that I've heard that term bull and bear, and the way that it was explained to me, which I think is easy to understand, is a bull market, you think of the bull with the horns going up, so that means the market's going up, and the bear with his claws pointed down, that means the market's going down for a bear
Right.
market.
Right. So bull markets are up,
Okay.
and the way I was taught was that bulls walk with their heads up and bears walk with their heads down.
Okay,
That was
similar.
just the way you think them. And we had a nice bull market run, and you also notice that the day-to-day changes are not as big as they are. There's a volatility indicator in the markets called the VIX,
Okay.
which is it's a measure of volatility. It's also called the fear index, and it's when the VIX is high, there's a lot of uncertainty, and investors are very unsure of where things are going to go, and they're shorting the market. They're expecting it to go down, and right now we're in a period where the VIX is very high. If you take that same chart and take it out to 2 years, you can see the period that we're talking about just this last month and a half. But if you look back about a year to last summer, you see another period where we had that extreme volatility. And what you see is that in both cases, we fell off a high into that period of volatility. And coming out of it, which is what we hope happens again, like you said, nobody's crystal ball is going
Right.
to show them the future. We can look at what's
Sure.
happening right now, what happened in the past. The last time we came out of a period of this kind of extreme volatility, we had a nice 4 to 5 month bull market run coming out of that. And that's what we hope is going to happen again.
So we're hoping that we'll see that nice line moving up again.
Now, the fact
after
that
this
we are,
volatility.
the fact that we're moving into an election year, we're going to have a lot of politics going on.
Yeah.
We've got the government fiscal years coming up October 1st, and
Okay.
I think we're still running the government on continuing resolutions like we have been for the last 2 years.
So the government still isn't passing a
We
budget.
still
is what
don't
you
have a
explained.
budget, and when we get into a political season, kind of all bets are off, because as soon as it looks like one candidate who might be considered pro-jobs, pro-people, whatever, looks to be pulling ahead, then the markets will get happy and rejoice. And then if that person falls back or says something stupid in a debate, or somebody uncovers some dirt on them, and it looks
Right.
like the other one who's considered by the investors to be anti-market or anti-jobs, then you're going to see it sell off. And election years are usually pretty rough ones for the market. What's good is the year following an election usually tends to be a very calm year.
It's a little more
And
stable.
whether it's up or down, you can make money in that market, but you have
Okay.
to be careful. It's the volatility is going to kill you, because the
Right.
volatility means nobody's programs are working, or the programs are kicking in because stocks are moving more than they think they will, and that causes more selling than anybody intended.
Okay. Really interesting stuff, and I love the visuals and the charts. I'm a very visual person, so it's neat to see the graph and how it moves. But before we finish up today, I want to talk a little bit. I also heard that the IMF, the International Monetary Fund, downgraded the forecast for the United States. And so I'm thinking, how does that work in conjunction with what's happening in Greece and some of the uncertainty in Europe and the EU, and what are your thoughts there?
It's kind of related, kind of not. At the same time, I think it was Lagarde said that the banks in Europe aren't in as bad a shape as everybody would like to believe.
Okay.
The downgrade of the U.S. was the downgrade of the debt, saying that our debt is a little riskier than they thought. I mean, we got, when S&P downgraded us from AAA to AA, still investment grade. It might mean we have to pay 1/4 point more in interest to entice people to buy our debt. I don't think we're in danger of defaulting. Now, Greece and Italy and some of the other European countries may actually default. If they do, that is going to hurt Germany, France, the U.S., Switzerland, the big companies that actually own some of that debt, the big countries that own some of that
The
debt.
smaller country debt.
That own the smaller
Okay.
country debt.
Okay.
And it could be, it's just going to be more uncertainty.
More uncertainty.
They're going to have to print more money to bail these countries out, and it's kind of a vicious cycle that we don't seem to be getting out of.
Yeah, what's the long-term effect of these people initially being bailed out and getting some money? I mean, what happens long-term to France and some of those big banks that hold the debt?
Same thing that's going to happen here. It's borrowed money. It's going to impact us in terms of taxes.
It's going to be taxes, so that's how you think that the local, average citizen,
That's how you and I are going to feel it, and the kids that aren't even born yet are going to feel it.
Scary stuff. Well, hopefully next week's Stock Market Corner will be a little bit more optimistic.
We can hope.
We'll see you guys next week.
Thanks.
And now, here's this week's questions for classroom discussion. Number 1, how do you know how much liability coverage your auto policy should contain? Number 2, will using coupons help lower your food expenses? And the final question, what is the Federal Reserve twist?